Hello?
Hello.
All right, just testing because I'm having all sorts of problems with my
I,
computer.
I could hear you perfectly.
Okay, thank you,
So,
Kevin.
sure.
Who are you with, Kevin?
I'm with Franklin Templeton. I believe Anthony and Lou should be joining in the next couple minutes.
Okay, I think I just invested with you a little bit.
Great. Well, thank you.
Well, that was recommended by those two, so particularly Lewis. So
That's great. I appreciate it.
just keep making money, that's all.
We will. It's always our job. That and making sure you don't lose.
I'm willing to take a little loss.
Yeah. Oh, it's the right attitude. And remember, it's not a loss.
The right attitude is, I tell my kids, my dad, I'm sure we all have the same, well, you're probably younger than me, but my war story is my father didn't even have a credit card, no less. Everything, we walk around with paper bags full of money to buy cars.
Sure.
Because he believed in that. If you didn't have it, touch it, feel it. So, but 0.1% versus, I don't care how rocky the road is. I graduated college. Dow was at 300. Now it's at what? 30,000?
Yeah, around 28.5 or so, around 28,000. But
Just don't look for that money to pay bills, but when you're investing.
you're right. I mean, investing, and you'll hear that today. I mean, investing is about life. It's about short-term needs, medium-term needs, long-term needs. And if you, that's what you're investing in. I mean, the goal in life is to not run out of money. So I love what you're saying. It's right on. Hey, Anthony.
Mr. Golden, how we doing, sir?
I'm good. How are you? We've already kicked off a good start. Was that Steve who was talking? I just want to make sure I got the names right.
Yeah, I'm sorry, Steve Plate. Yeah.
Yeah, that's right. No, I see your name, Steve. Steve kicked it off without me even asking, and he started talking about investing in equities and long term, and and what rates are paying right now. So he had an excellent thoughts and approach.
It's on point. Nice. So how's everybody doing? Right?
I like Cody. Look at him.
There
You
you
trying
go.
to sell some, Cody?
Hey, who's that? I can't coming in.
That's Anthony being a wise guy.
I think whoever's somebody might have a bad connection. The internet might be going in and out.
Yeah, you're going in and out, Anthony.
I am?
Yeah.
Anthony, I can hear you pretty clearly. I think you're pretty good.
Okay. Good. So look, I mean, I don't want to take too long. I mean, I know we got quite a few more people that registered for the event, so I'm going to wait, maybe another minute or two, and then, we'll look to kick it off, and hopefully we answer, all the questions that we have. I see, I think we got a good event for you guys today. It's definitely a hot topic, that's for sure. There's no question about it. So Cody's got the Franklin Templeton background.
Yep, it's actually there too.
I know. Sometimes I see, when somebody has virtual backgrounds and they, it's not very clear, and then it gets all, kind of muzzled, and, it's good to see that one's pretty clear. You show up against it. So maybe you have the green screen behind you. I don't know.
Yeah. It's that Zoom technology really stepping it up during COVID times, I guess.
That's it. Beautiful. Kevin's home office looks like our office, right? The navy blue and the white,
Keep it simple, few colors. Don't overdo it.
Don't overdo it. Exactly right. So
He's got the big circle light in front of him. You just don't see it blasting his face, so he looks nice and pretty over there.
That's it. Yeah, I know. I have one of those things. I feel like, everyone says you need them, but I don't use it too often. I keep the sunlight coming through our skylights in my background here. So
there you go.
Do the little things you got to do. That's all.
Do the little things that we got to do.
The only thing I'll say is when this is all over, I want to walk through every one of your houses and see how clean it really is, because those rooms are spotless. There's got to be outside the perimeter of this picture. I think the best commercial is the guy on the weekend goes to Home Depot to buy paint because he had chips his paint was chipping behind him. Did you see that commercial?
I didn't. No.
Oh, it's pretty funny because, you think about you doing your thing, right? And no one was looking behind, the guy was just doing his meetings. People like the big talk in the office was that guy's house is falling apart. So he went out in the weekend and bought a gallon of paint and painted his house, and he was proud. So he
Wow,
can
gotta-
present.
Gotta love it.
We've
You gotta love it.
in 6, 7 months of virtual meetings, we've seen so many wild things going on in the backgrounds of people that they wish that their camera was off for. So I got a lot of good stories on that.
There's some really bizarre stories.
Yeah.
Like people in the bathroom and forget to
Oh,
put
yeah.
it on mute.
Oh yeah, absolutely. See it all the time.
Beautiful, beautiful. So I know we got a few more people that came on here. There we go. Let me do this. All right. So look, I want to be cognizant of everybody's time. I appreciate everybody coming on to the call here today. I think we got a really good event. We're going to talk about the elections. We're going to talk about the markets and everything in between. The reality of it is this is a very hot topic. When we look at where we are in the current economic environment and all the chaos that is ensuing, regardless of whatever political affiliation you may have, there's certainly a lot of questions with how this election is going to impact the markets, the balance of this year, and quite frankly the next couple of years. And if the fourth quarter didn't come with any listen, if it wouldn't be 2020 fashion if the fourth quarter did not come with any more surprises, right? So we opened up literally the day of the fourth quarter, with the president getting announcing that he's got COVID-19. So look, I wouldn't expect anything else. I think ultimately, we're going to do our best to try and answer any and all questions that anyone may have. Hopefully, and if not, we'd be open to additional, conversations and suggestions, and happy to schedule that for you guys. We have, I think, really, really, really good people, partner firms of ours that we bounce ideas, strategies, insight, information off of, and those that feed us information, and they are phenomenal, great partners of ours. Kevin Golden, Cody Squassi, Kent Shepard from Franklin Templeton. These guys, look, they're extremely knowledgeable. They do these things all the time. They talk the talk, we walk the walk, and they walk it with us. So without them, we would not have a lot of the information that we have. And then secondly, quite honestly, they're managing some of your money. So, obviously these are guys that you want to hear from and you want to talk to. So without further ado, I'm going to pass it off to Kevin Golden for another brief introduction of his counterparts. But look, as I said before, we're here to talk about the election, the markets, and everything in between. So Kevin, do me a favor, take it away. Before I do that, one last thing to everybody. While I want to keep this as interactive as possible, we are definitely going to have the opportunity for questions and answers. Ken is going to give a small presentation, on his thoughts. But we will definitely open it up for question and answer, and that'll keep the interaction and the conversation going. So appreciate it. I'm going to mute myself. I'll step in as needed for a period of time. But in the interim, Kevin, take it away. Thank you.
Great. Thank you, Anthony. Thank you, Lou. Thank you for your wonderful partnership. Just a few comments and before I introduce our main speaker. I'm in the financial services industry my entire career, right out of college, 24 years, which is long enough now to have a pretty good history of the markets, but I'm also a student of the markets going back many, many years. And I would definitely say that I don't think there's ever been a time where it's more important to be getting great advice. And I say it for a couple of reasons. I say it, number one, because we live in a world, like Anthony said, that it's just 24/7 news and noise. It doesn't matter where you are politically, what polarized views you have. The bottom line, at the end of the day, we all want the same thing. We all want to have financial freedom. We all want to make sure that our near-term liabilities, needs, bills are paid, and all the things we want to save for in the future. I mean, at the end of the day, if you're talking about retirement is about, or successful retirement is about never having to worry about money. So it has never been more important to get great advice. You have great advisors in Anthony and Lou. And, you know, if there's other people in your lives, friends, workers, colleagues, family, neighbors that are not getting great advice, you know, simply make an introduction to Anthony and Lou. Because at the end of the day, like I said, we all want the same thing. We all never want to have to worry about money. And it's so easy to get caught up today in something that you heard, that you read, that your friend said. And you need to really, I think what a great financial advisor does, what Anthony and Lou are great at doing, is kind of, you know, putting blinders on for you and making it about your personal needs. So I just want you to step away and just remember that. Many of you on the call probably know that. You're probably thinking, Kevin, of course, it's about advice. But you know what? It's so easy to watch the debates tonight and hear something about taxes or hear something about COVID and say, oh, that's it. I want to do this with my money, that with my money. Do your best to focus on the great advice you're getting. All right, with that, I want to turn it over to Kent Shepard. And let me just give Kent a quick introduction. First of all, Kent is sitting in his home office in the San Francisco, San Mateo, Northern California Bay Area. Okay, you do see his biography in front of you. So rather than being boring and reading that, let me just tell you who Kent is to me. Kent has so many roles at Franklin Templeton, as you can see with those blue dots. He's in portfolio management roles. He's in what we call institutional portfolio management roles, which means he's the guy who's out in the country talking. Most of it over the last 6-7 months has been virtually, but he's the one who's representing the people that day to day are analyzing companies, trading the portfolios, managing some of your money. So he's kind of the interface between me and the portfolio managers. He's got well over 30 years in the business, most of which with Franklin Templeton. And some of you on the call have heard of our founder, Sir John Templeton, a legendary name, a pioneer of global investing that passed away about 12 years ago. Kent's one of the few people left at Franklin Templeton that actually worked directly with Sir John Templeton. So he's got amazing history there, but I think you'll love what he has to say. He really says it in just a very, not just easy to understand, but applicable to your life right now way. So with that, I'm going to turn it over to Kent to make some comments about what you should be thinking about over the coming weeks and after the election, what kind of effect it could have on the market, and just our outlook really going forward. So with that, take it away, Kent.
Great. Thanks, Kevin. Thanks, Anthony. Thanks, everybody, for the warm welcome. And as mentioned, I'm going to just speak for a few minutes, and let's dive into a conversation. I'd love to hear what you're all thinking about, and we'll share what we're thinking about. I'm lucky to sit on a team that is a hub, a clearinghouse of the best thinking and insights of our company across the globe, across sectors, across regions, across asset classes. And we just had one of those meetings this morning, and it's great to get a lot of different perspectives, and we'll share our perspective. And I will spend a few minutes on the economy, but I think I'm gonna first, just to make sure we deliver the goods, I'm going to go right to the election portion, and then I'll circle back and get a little more big picture. And I think I have to reshare my screen here.
You're good to go, Ken. I see you.
Yeah, we could see it, Kent. We're
good. Okay. Sometimes when you change, it unshares. Okay, so yeah, we have this election coming up, if you haven't heard, right? And I totally agree with the importance of not being overly reactionary and talking ourselves into major tactical changes based upon things that may or may not occur. We have a division that does trust services and estate planning, and their note was, it's not usually a good idea to make major changes in the portfolio based purely upon tax considerations. Now, certainly there's munis and there's certain places for tax considerations, but you know when it's most important not to do that? It's when we don't even know what the new changes are going to be. And the temptation is enormous. We all want to get ahead of the curve and make changes, but we just don't know enough yet. I'll give you some basic framework for navigating this uncertainty. And it is true that and you've heard this before, but what you're looking at is the blue bars here mean when the government of the United States has some Democratic and some Republican representation. So they call that divided. Unified would be the same party in the White House, the House of Representatives, and the Senate. And the reason that might be a reason that equity markets tend to do less well, whether in normal times or all times excluding recessions, the bright blue bars are lower, is that there's this concept of gridlock. you've got enough disagreement, only little changes made. And we know that change is uncertainty, and markets don't like uncertainty. So the reality is, and I'm completely apolitical here, I don't aspire to show any bias in any direction. I want to convey and relay insights rather than take a view here. The polls, real money polls. If you after we're done here, you might have heard of Predict It. Go Google Predict It. It tracks with real money as if people were betting on the horses or games in Vegas. It tells you the odds of various outcomes. And the odds of all three branches of government going Democratic have increased significantly, depending upon whose interpretation, anywhere from 60 to 72% would be a Democratic sweep, whether that's because of COVID, whether that's become of perceived performance in debates, whether, myriad factors. But right now, it's looking like if the betting markets with real money, not polls, because we've learned from the last election, polls aren't necessarily a reflection of what people are thinking because not everyone responds and there's some selection bias in those. But people placing money on the table is probably a more valid gauge of what consensus views are. So we do know that under Trump's administration, tax rates on corporations went down. So both the statutory rate, meaning, by the book before any legal loopholes, and then the effective rate. That means, well, what if I have 70% of my multinational revenue in Ireland? Well, there you go. You've got a much lower tax rate. So some of the giant corporations that dominate the S&P 500, if you buy the S&P 500, you're buying huge weightings in companies like Apple and various others that benefit tremendously from having legal, intelligent, thoughtful plans around how to lower their tax rates. Under the Biden administration, I don't view it as good, bad, or indifferent. I'm an investor. You do see an aggregate about a 10% decline in S&P 500 earnings, and this sort of gives you some granularity on where that comes from. That statutory rate. The minimum rate, well, what is that? The minimum rate is, what if I'm Amazon and I am growing so rapidly and I'm buying warehouses and computer servers and trucks and infrastructure and warehouse space, and I get to depreciate them. The depreciation on my infrastructure means my earnings are wiped out from a tax basis. Well, not under the minimum corporate tax rate. Even an Amazon will become a larger taxpayer. The GILTI, G-I-L-T-I, is basically making sure you don't hide earnings overseas. And then there's some view that the broader economy may soften, and therefore the broader revenue base from which we earn taxes will go down as well. Another way to look at it, and this is a little bit confusing here, but what we're showing you is we put the three different basic effects: the statutory, the minimum, and the foreign GILTI, and then the sectors most affected. So healthcare and comm services. Remember, comm services now is a bunch of internet media companies that used to be in the tech sector, but 2 years ago got shifted to comm services, communication services, and some into discretionary. So you see, though, on the left, the bars that go down the furthest are the sectors who are under different methodologies anticipated to have the biggest hit. By the way, those are heavily skewed toward the largest sectors of the S&P 500 in terms of the weighting. So it's not something to be dismissive of. The other element that's more direct and personal for all of us is proposals that may or may not be implemented to have the tax rate on long-term capital gains shifted to ordinary income. Therefore, those stocks that are big gains that you've owned for a few years, well, the tax on them when you sell them will be higher under the preliminary proposals of the Democrats. So there may be a sense of, gee, I better sell now before the after-tax profitability of my investment goes down. Why don't I sell now? That may or may not become a factor going forward. So I did want to spend the first few minutes specifically on the election. We can go more into Q&A, but I'm going to sort of circle back now to the backdrop in which all this noise is occurring. Of course, we've got the vice presidential debate tonight. Pundits, not me, but observers of policy and politics observe that versus other times in history, the articulation of what it is exactly the president on the Democratic ticket has in mind hasn't been quite as explicit, because the goal is to convince us not to vote for the other guy. I think we all know who his name is. And in my lifetime, I don't know of an election where it was so much about, for God's sake, don't vote for him. Now, I'm not passing judgment. Again, I'm saying that the platform is anybody but him. So the need to have concrete proposals on the table, some argue, have been articulated more by the most far left progressive voices. So some articulate that if the Democrats win, those very outspoken voices who, hey, more power to them, have said, here's what's wrong with our society and here's what I'm going to do to fix it. It may well be that we have a bit of a more progressive outcome than we would have. That's one side of the argument. The other side of the argument that I as a layperson, just a citizen of the United States, is that people say one thing to get elected, and they don't always do that exact same thing when they get elected. So there may be a bit of a more of a moderation, but to appeal to one's base and the Democratic, you've got to be fairly colorful in your proposals. So what's the backdrop economically? We just had the biggest decline in GDP, gross domestic product, collective output or goods and services produced, biggest decline since the Great Depression. And what I put there in those red and yellow stars were just to call out the other times that those up and down vertical lines go below zero, meaning when we had negative GDP growth. Each of them, first of all, way back to the 50s, was a fraction as severe as the one we've just gone through. And each of them was caused by some specific flaw. Maybe it was the housing market, 08, 09, and banks who were making loans for various reasons. 2000 out here in California, we had all these tech companies that were worth nothing but priced at billions, and that caused a bubble in the economy. In the 90s, we had the Gulf War. In the 80s, we had to raise interest rates to 15% because we had inflation, and Paul Volcker had to bring the 10-year to 15, 16% to slow inflation. I'm citing these historical data points because in each of those cases, there was something broken that needed to be healed. Fast forward to today, we had arguably one of the strongest economies in decades, with unemployment at all-time lows, even among the most historically challenged educational, socioeconomic, racial, ethnic, geographic groups. Things were doing well, going well, until we had this very, very, very major extraneous, exogenous factor, COVID-19, hit us. So why does that matter? It matters because there's a presumption or a temptation that when we enter the wonderful game of alphabet soup shape of recovery, there's a temptation to believe that we're going to have a V upper left, just in case anybody forgot what a V looks like. I put it on the screen. So the idea is sharp decline followed by a sharp recovery. That may be a little bit optimistic, because we all know that consumption is something like 2/3, maybe 70% of GDP. And we all know that American households have seen their incomes decline by a lot. It reminds me a little bit of John Templeton's, one of his many sayings, when I heard him many times be asked, of all forms of advice around money, investing, and finance, Sir John Templeton, what's the number one? What overrides all other pieces of wisdom? And he would inevitably say, people should never, under any circumstances, and by the way, this reminds me a little bit of one of the guests before the call. I was thinking this very thought, listening to that conversation. People should never fund consumption with debt. If you don't have the money now, don't buy it. Mortgages, bad idea. Car loans, bad idea. Student loans, bad idea. Credit cards, crazy idea. Those were the words of someone whose family was decimated by the Great Depression. My grandparents were the same. That frugality, that concern, that reluctance to incur debt was something that the Great Depression caused them to never let go of. As the Dow went from 300 to 5,000 in their lifetime, they still had a conservative, cautious view. And it may well be that American households, once this virus runs its course, or the vaccine's here, or herd immunity, whatever the scenario, it's not clear that those depleted rainy day funds are going to suddenly start to behave in the same manner There may be some pent-up demand, but as we think about this, we go through this alphabet soup, and you can kind of probably use your imagination to envision what they mean. The reverse square root on the far bottom right kind of makes sense, where you have a sharp decline followed by this seemingly rapid bounce off the bottom. But it's not clear that the pace of that rebound will sustain. I don't know if there's a college campus that's reopened that hasn't had a relapse. I don't know if you followed UK and Western Europe, where they're opening, with the exception of the Scandinavian countries, huge relapse. So it's not clear that we're off to the races, obviously. We may have a second wave of COVID. So the most recent alphabet soup was brought up in the first debate. I was very surprised to see that one of the questions, Wallace, was it Mike Wallace? Chris Wallace, Mike Wallace's was dead. Anyway, he asked the candidates, what do you think of the K? What is the K? Well, the K is the idea that you have the beginning of a V, you get the lowercase bounce, and then you have a bifurcation, the winners and the losers. Think of the FANG M stocks, the Facebook, Apple, Amazon, Netflix, Google, Microsoft, versus cyclical, slow-growing utilities. And this is arguably reflective of the haves and have-nots, both in the stock market as well as in the real economy. Where some of us, I'm fortunate, I have a job that I can do from my den, and not everyone has that luxury. And the bifurcation of the experience among households and stocks and sectors and industries is quite stunning. We're hoping that deviation, that bifurcation narrows, and what'll happen is, at some point, we don't know when, but at some point this virus will get less bad. It may well be it's something we live with and it lingers longer, but it will get less bad. And when it gets less bad, cyclical industries, which is a term for industries that get hurt more by a recession and it get helped more by a recovery, will come roaring back. And sectors that have negative earnings right now, not low earnings, but negative, they're going to have positive earnings. And then all the money that's been piling into the only place where there's growth, some of these digital technology companies, which are great companies, some of them are 20 minutes from me right now, but the money is piled into those sectors, may decide there's not a scarcity of growth anymore. So maybe we should be looking at some of these neglected sectors. That's when you may see a classic market rotation. The great debate is timing. And so it's really, nobody knows exactly when it's time to position for that rotation, but maybe you take baby steps. In my personal portfolio, I've taken baby steps. I own some utilities now. I own some small cap growth, some small cap value, just to plant the seeds, because I know I'm not smart enough to predict the day that Pfizer or AstraZeneca says, we got it, a vaccine that works. And when that day happens, these sectors that have been left for dead are going to come roaring back. And you don't want to be completely absent them, but I wouldn't necessarily say you bet the farm on them today either. Just maybe start planting some seeds. So maybe 5 more minutes. Does that sound about right? Good. Okay, because I get talking and I forget how long I've been talking. So if you look at the returns, really fascinating year. On the left, you're looking at the lower the dividend, the higher the return. The higher the dividend, the lower the return. So if you are running a portfolio that invests in yielding stocks, you've been getting your head handed to you by high growth managers. And this is a little bit more intuitive. The lowest earnings growth has meant the lowest returns. Highest earnings growth, highest returns. That makes sense to me. But in a world starved for yield, $17 trillion of government bonds around the world have a negative yield. Someone wants to talk about what that means, we can do it during Q&A. But if I'm a German or Japanese investor, I want to buy their 10-year treasury equivalent, don't call it a treasury, but let's say they did, about negative 0.4, negative 0.5 per year. So all of a sudden 0.7 in the US sounds good. Even high yield bonds in America sound good, even though their yields are lower than they usually are during a recession. So there's a lot of behavior around low rates that we've got to be careful of as investors. I think this is an important slide. It looks a little bit complex, but just look at the left side. This analysis done by Morgan Stanley, and I'm friends with the gentleman who did it, great guy, took America's households and divided them into 3 pieces, the lowest income on the left, the middle, and the right. But what fascinates me is on the left, people who may earn the least, who have the lowest paying jobs, You can envision them, services jobs, right? Where the restaurant, airline, various other retailer are closed. They've seen the biggest decline in their income, but their spending has fallen the least. That means those checks did something. The largest fiscal monetary stimulus package almost in history back to World War II is actually helping people in need. So that's a good thing. I think that graphic there tells me that subsistence spending to put food on the table and keep the lights on and pay the mortgage is happening because of the government stimulus. It does not come with a free lunch. We are now about to see the largest deficits since World War II. So total debt relative to GDP, as well as annual debt relative to GDP, we are now rivaling the largest conflict in our nation's history, where we were spending on military apparatus and how the GDP decline. So we do have to wonder and worry about the long-term consequences about that, but maybe it's a war. Maybe we're having a war with the virus, and maybe we need to spend, but we need to think about the long-term implications, and maybe in the Q&A we'll get to that. But I wanted to touch on one last thing before we go to Q&A. I mentioned those FANG-M stocks. Here they are. If as of June 30, the trailing 12-month period, those stocks are up 50% as a group based upon their market cap, the rest of the market was down 0.5%. The most concentrated leadership of stock appreciation in my lifetime. And this looks like a bunch of boring stats, but let's talk about them for a second. This is updated through September. Those 6 stocks up 75%, the other 494 up 8%. Top 5 today in the S&P, 23% of the total value of the index, 8% 10 years ago, 5% 15 years ago. Meaning, any time in recent history, when more today than ever, when you buy the index, you're buying a very, very, very narrow list of very powerful, very successful, very successful companies. But just be advised that if you look at history, only one of the S&P 500's top 10 stocks a decade ago is anywhere in the top 10 today. Each of the number 1 stocks in the S&P 500 the last 5, 10, 15, 20, 25, and 30 years ago, none of those stocks, number 1 stocks, are even in the top 10 today. So it's a dynamic world. And it may well be that Facebook and Amazon and these names continue to dominate. But we need to, as Matt Moberg, who runs our Dynatech fund, says, I'm really more interested in tomorrow's FANGs. Today's FANGs are for the index funds that already own them in huge bulk. I'm looking for tomorrow's. That's where you're going to see the real appreciation. So I agree with him on that. Why don't I stop there and toggle to any topic that's of interest to folks?
So Ken, so obviously I'm sure most of us watched the debate last week, and they really didn't get into any nuts and bolts of policies and their plans for the future. Obviously it was just kind of a pissing match left between one another. Mm-hmm. How just based on what your research desk is seeing and talking, how do you expect the left versus the right plans or policies, or what we know of them, to have an impact on the market moving forward?
Right. So
it's a tough one.
Yeah, and I don't want to. I'm really, really trying to resist sounding biased, because I banged on the Democratic effects on tax rates. So my goal isn't to be that way. But if the views expressed by the left, which may be very good ideas, it's beyond my pay grade, but including green energy, there could be significant hits to energy producing states, countries too, I suppose, but states and counties, and the tax proceeds of those places, the incomes of those places. Out here in California, we can tend to kind of view ourselves as like environmentally progressive and things like that. And we've got our Teslas and our Priuses. Well, I'm not sure if everyone driving one of those cars realizes that under the Green New Deal, they're part of the problem, because those cars are powered by electricity produced by either coal or natural gas. And in the the most rigid interpretation of, say, the Paris Accord and other environmental movements, natural gas is on the bad boy list too, because it's a fossil fuel that hurts the environment. So we have a long way to go in terms of renewables, solar, hydro, wind, even some biodegradable resources. But it's probably, if the policies are implemented quickly, then it could be a bit disruptive to the real economy, could even be inflationary based upon the cost of acquiring electricity. The utilities would have to scramble to find other sources and raise rates to pay the bills as they transition. NextEra, the old FPL, is a great company that's probably the #1 best utility positioned for the next era. Good choice of new name, right? So that's a name to look at, but it's not cheap. It's not your grandfather's utility stock. It's more of a growth than a value stock. Financials. There are certain members of the Democratic side that feel that the financial sector still needs to be reined in more and told who to lend money to and things like that. Big tech, and by the way, it's not just Democratic, but Mr. Cruz from Texas, Republican. What am I? I'm not. It's not Tom Cruise. Ted Cruz. Yeah, he spoke on the floor of Congress just last week, saying that today's fangs are yesterday's robber barons in terms of market concentration. And maybe he's right. These companies have the capacity to squash any upstarts, and maybe there is something necessary there. But if you look at the bloated maybe is unfair, very sizable weighting of these companies in the S&P 500, and they become systemically told to break up or slow down, that could be an interesting headwind for the markets. You've got healthcare, you've got different plans, different drug companies. Trump himself has done a lot to try to drive down drug prices, pharmaceutical prices, encourage imports. He does point out that the same drug costs 20% as much in Canada as it does here. So maybe there's time for some of that, but we just have to be careful that we are thoughtful about the stocks we own if there are major changes to the rules. So when I think about the policy implications, those are some of the first things I think of. Some people feel that Biden and team will be a little more soft or conciliatory toward China, maybe tariffs and trade, kind of take a time out on the rhetoric. That has implications as well. Military defense, Trump has committed a lot more to spending on the military, and that has implications for aerospace defense companies. So those are the first investment implications that come to mind for me. But I think both parties have no problem spending money, and at some point the money we spend could have implications for long-term inflation and interest rates. That's not next month. That's not 6 months, but 2 and 3 and 5 years from now, we may see some inflation surprise as we deal with these deficits and money creation.
Beautiful. Okay, so a couple more from me at least, and I don't want to hog everybody's time, but so look, I mean, you talk about how dividend stocks have underperformed growth stocks, right? And if you throw Tesla into the mix, it makes it even worse, right? So generally, one would perceive dividend stocks as being, a more safe measure than growth-oriented stocks, right? And coming into such a split, election here where there's a whole bunch of other concerns, you can't even really hide in dividend stocks, right? So I guess, the question, ultimately becomes is, are you seeing managers, are you seeing, guys saying, okay, well, we had a 50% run up off the bottoms of March. We've captured quite a few gains. Maybe we should be, harvesting some cash and taking a more defensive position. Fundamentally, dividend stocks make a heck of a lot of sense, but practically it just hasn't come into fruition. So, whether that tide changes, I don't know, but would you be hiding there? I know you mentioned, utilities, so on and so forth, or would you actually be hiding in cash, and just kind of giving some flexibility towards, future bargains?
Hey, the most candid and honest answer I can give you is what I'm doing with my own money. And what we've seen in some of the portfolios. Yeah, we have a little cash on the sidelines. As much as anything, though, to be that part of the portfolio, my collective wealth or worth that doesn't fall. Because when the equities that I own perhaps incur some unexpected event that fall, the weighted average decline is less when you've got some money on the sidelines. But the psychology, the urge, the inclination, the panic to sell at a market bottom. Selling at a market bottom is the single most consistently, profoundly negative thing that happens to household individual investors every cycle. It becomes too painful. The market, we all lived through this, but the market fell 34% back in February, March. And it just became so painful that people started to say, I can't lose another dime. I just can't. And then they start liquidating toward the bottom, and then they're not there for the most rapid rebound in financial market history. This blue line is the average of several past rebounds off of the bottom, and the black is the current one. So the lines across the bottom, horizontal, left to right, are the number of trading days. So we saw the most rapid recovery. So the brutal effect of selling at the bottom was the most severe. So to me, kind of like having a life insurance policy, there's opportunity cost because you're paying the premium, but the comfort in your family and household's collective well-being by incurring the opportunity cost of having an insurance policy is worth it because it does not lead to extreme or panicked or desperate behavior. So I can't tell you if stocks are going to go up, stocks are going to go down. We were buyers in February, March, but we didn't realize how quickly they would come back. So we didn't spend, as a company now, our funds that I'm associated with, we spent about half of our dry powder. And then the market ran so quickly, we decided, let's slow down, let's be more selective. We've chipped away at utilities as one example in an income strategy, mainly because utilities performed every bit as poorly as the S&P, fell 30+% and didn't recover. And this is going to be this is a bit of a complex, wonky idea that bond guys like to talk about. But we know the concept of duration is the sensitivity of a bond to interest rates. So a bond with a long duration gets hurt more in price if rates go up. The classic long duration is a zero coupon 30-year bond. No cash flows until 30, you get a bullet after 30 years. So the timing of the cash flows way out into the future. Therefore, when rates go up, the present value gets eroded. When rates are down, the present value doesn't. And guess what growth stocks are? Growth stocks are stocks that have more and more and more of what you get as the investor out in years after the growth is even higher. Utility and cyclical stocks are short duration. So some credible strategists, and I happen to believe and agree, rates at historical lows have meant the value of growth stocks, where you get the pile of gold far away, the value has gone up because the discount factor, inflation and interest rates, has been less. So if we see any bottoming, that's the double doozy. If we see a bottoming in the economy, we're going to see a normal rebound inflation, and the non-growers are going to become growers, and people are going to start buying cyclicals and financials and energy companies and some discretionary left behind and some industrial companies that have been hurt. And that's when you get the combination of the effect of rising rates and a rotation. So that's what I think you start to plant seeds for. A very long-winded answer, I'm sorry, but I'm very comfortable with having a defensive corner of cash equivalents, not long-term bonds. Because rates are so low that if rates go up, you're going to lose money on that part of the portfolio that was supposed to be defensive. Right. So I prefer true. You get 0.1% on them, but that's not there to make you money. It's there to preserve capital. So that's just fine in my book.
Okay. I got one more and then I'll be quiet. So, and arguably, I think this might be one of the most important. I've had this conversation with clients. They've, multiple clients have asked, right? So you look at who wins the election, right? Doesn't matter who it is. There's arguments to say that there's going to be turmoil and chaos and or uncertainty long beyond November 4th, right? I mean, so we know that we suspect that there's probably going to be some sort of contesting of the election. We may not know who the president is for a couple weeks, maybe even a month. One side says, well, if this guy wins, we're going to create havoc on the streets, and we're going to riot and protest. And so, look, I mean, there's chaos tends to ensue. Markets hate uncertainty. I mean,
Right.
Realistically, any comments around that? I mean, like if we don't know who the president is till the end of December, any idea of how the markets are going to take that?
Yeah, I shudder to, no, I shouldn't say shudder. Let's just say the term President Pelosi becomes more possible if we don't have a
Right.
proved winner by, I think it's January 11. So I think that you're right. I hate to become such a sociologist in an investment call, but talk about just a volatile cocktail of some racial issues, some real hit to household incomes, a perception of inequality, which may be real in terms of not just law enforcement, but opportunities, and then an enormous amount of idle time with checks coming. And it's a recipe for people to have time to express their frustration, whether warranted or not. And it's just this perfect storm. And now you have one candidate that, rightfully or wrongfully, is associated with all the ills of society, maybe extremely so, such that I think that the market does brace for social unrest in a Trump win. And I think that as the polls show, Biden having a more clear, not just squeakily, but robust win, even though a Democratic sweep means a lot of negative things for the financial markets, for the value of stocks and on a tax basis, the social stability that may result in a Democratic sweep, I think the markets are saying that's better than the alternative. And now even just yesterday, midday, I almost lost a burrito bet yesterday because I said there's no way either party will allow themselves to be to blame for a lack of a stimulus package before the election. There's just no way. Midday yesterday said, forget it. I'm calling off all stimulus until after my reelection. And then he got home from the hospital and he reflected and said, nah, I'm willing to talk. And then today we're up huge and erased all of yesterday's losses. And it looks like the odds are back up to get a second stimulus package before the election. So I think you're right. I think the markets are placing bets, and the bet is near-term uncertainty is minimized with a decisive Biden win, which does not require a lot of hanging chad uncertainty, state attorneys general making judgments to determine the winner. So that's what I think the markets are deciding. Even net of some of the headwinds for specific sectors and tax aspects, I think a social order outcome is one that the markets are paying up for right now.
Okay, good. Thank you. I'm going to be quiet and I'll allow everybody else to talk.
Well, I had a question or maybe a thought. This is Steve. This thought is, if you're investing your money, and I think probably everybody on this call believes in that the money you're investing is not what you're going to pay your mortgage with next month. Otherwise, you're in trouble. So we're in for the long haul, right? And I'll say it for myself, I'm in for the long haul. Hopefully I have a good life and my sons, and what I hear, not you're saying, you're not being explicit because you don't know. I mean, let's be honest. If you knew, you wouldn't be sitting here talking to us. You'd be somewhere else on an island. But the thing is, right now, what you're saying is really about positioning. Let's be real. I've heard my son's in the business and he says, Dad, get ready for Rocky Road. And I lived through it in 2008. Okay, that was the last one. Mm-hmm. In 2008, I was doing great at 12,000. It dropped to 10, then it dropped. And I said, you know what? How am I going to tell my wife I just lost all this money? So I did what you said. I sold out and the market came back. So a friend of mine called me at the beginning of this whole cycle and said, are you getting out? I said, no, I've learned from the last one. Because you can't time, when you time the market, there's timing twice. I got to
Correct.
get in at the right time and get in it. If I could do that, I'd be retired many times over.
Right.
Okay. So what I see happening is, I mean, everybody makes their own decision, is look for some quality mutual funds, whatever stocks, whatever instruments you believe in, and then continue to move forward, knowing that you're going to have this spike. You know, I always use this simple, dumb, stupid. When I graduated college, it was 300. This 500 was the Dow. It is now 30,000. So it will go up. Now you're right. The AT&Ts are no, I don't know if they're still in there, but they took a major hit in the 90s and they disappeared. So you have to that's where you guys earn your money. You got to pick and choose, and I'm not quite sure exactly how you do, but you're going to have to adjust. Now, if I read an article recently, and articles are worth as much as they're written on, but he said for some reason techs are going to take off because he's big into techs, Biden. So you're going to have to adjust if it's true. But the point you were making, Ken, you're not going to start speculating on what he's going to do until he starts to show a tendency and lays out his plan, because otherwise you're just purely speculative. So it's going to be a rocky road for the next quarter. And if even it gets caught up in this whole drama, with the election, it's going to just, I mean, if I could kind of summarize what you said or what you were laying out, and we're going to come in unless the whole economy collapses. And if that's the problem, we're back to hiding in like hiding toilet paper and paper towels like everybody started to do during the COVID thing. But in reality, it was an overreaction. So is that pretty much lays it out? I mean, you got to decide for your family when you jump and when you don't jump. But history has shown consistently the economy, the American economy especially, is by far the 1,000-pound gorilla. And no matter what, once it gets certainty, it's during the uncertain time, it bounces around a lot, up 500, down 500. But once it gets certainty, it'll just power drive and kick into high gear. And you guys just got to read. I say you guys, the Franklin's in the industry and the Anthony's and the Lewis's have to read that for the clients. Is that pretty much how I can read all the articles? Like they said, energy is going to go up. Like I've always said on energy. Hold on a second. The coal-fired plant. I mean, where's the zero green? The only real green is power, hydro and fans, and wind. And that probably has some environmental impact on some carbon dioxide. So
Should I chime in?
It's going to be or anybody want to jump in? Someone wanted to talk. I'm sorry.
Anthony, would you like me to jump in or others to jump in?
Yeah, you're muted.
Sure. Go right ahead. Yep.
Yeah. So I really think you summarized a lot of my key concerns and points well. You are totally right that to time the market, you have to get out the right time. And how many people, when they see the market fall, become more confident of jumping in? In reality, it gets very psychologically different, because a 20% fall could mean a 34% fall, and it did this time. So you decide to wait, and it falls more, and then you get reinforced to wait, and the next thing you know, it pops and you miss it. So all the academic research says very few, even professionals, are good at market timing. All we can do is sort of assess the cards on the table and say, the next card could be completely what we didn't expect, but the cards on the table give us probabilities that give us an inclination to lean a certain way, knowing that we don't know. For me, when I referenced having some cash, anything that encourages and enables a steady mind when the crisis comes is worth its weight in gold. So if you had $100 and you was all invested in, and say 70 of it was in equities and 30 was in munis or something, well, let's focus on that 70. If you take 10 or 15 or 20 of that 70 and put it in cash, and that makes you not sell the rest if things fall, then it's done its job, because it's almost like having we've had terrible fires. It's having a ring fence around your property. If the fire comes closer, you're not going to panic and leave your home if you've got a huge ring fence. That cash buffer can be that ring fence. I have my niece I'm very proud of. She's a West Point Army Academy grad, and she spent a good part of 6 months in the deep remote areas of Texas, learning how to be the commander of an armored vehicle tank brigade. And for month after month after month, with greater and greater extremity and live ammo and explosions, they rehearsed. And my question to her was, well, in the next war, we're really going to have tanks? And she said, in the next war, all the satellites are going to be knocked out in minutes, and conventional warfare will be the way to go, number one. But her question to her commanding officer was, why do we keep doing the same drill over and over and over and over? And his response was, when we really have a crisis, we don't want this to be the first time you ever experienced it, because there's no room for panic. So I think mentally, emotionally, psychologically, a client, advisor, personally, myself, kind of rehearse how you will react if we do have a pullback, and have a plan to prevent the panic event. I have very, very successful, smart friends who are very accomplished in their fields, who sold all their stocks in March. And they've been, asking me what to do. It's not an easy answer. But any mechanism or action you take now to lead to a steady mindset later is worth it. So I'm not saying jump out of stocks. I'm saying position yourself to behave in a constructive way later. Does that make sense?
Sure does. Sure does.
Ken, I have a question, because I get a lot of this from clients now. So, a lot of my clients, I would say the majority of them actually obviously stayed in the market. We kept everything the same. Obviously, we'll tweak a couple things here and there. But a couple of them are now asking, hey, we made it through this, we're up, 10, 15% for the year. Maybe we should say, take some cream off the top and just, put it to the side. And some of them, and I'm okay with that, and I have no issues with it. But a lot of them give me a little bit of a pushback of going to cash, for that very reason, that it's not getting any kind of interest. So they're kind of like, well, what if we do as an alternative? And I'm not crazy about the long-term bonds, just like you said. If rates go up, it's just going to create more of a loss. Is there anything else out there that you could think of that could possibly be like a cash alternative, or just do cash and just, it is what it is?
I literally yesterday finished a research and thought piece for our CEO on this exact same question. How do you prudently mitigate equity market volatility? And there are many different possibilities. What you want to do is own something that doesn't go down when equities go down. So that's called negative correlation. Diversification doesn't work if what you own next to your volatile asset goes down just as much. So for me, for individual investors, after really studying all the different alternatives and tapping into other experts, boring, stodgy, old, easy to understand, highly liquid, but very low yielding money market funds do have a place. Again, like, you're never going to make money on paying your life insurance premium. It's not there to make you money. It's there to protect you. And I just have to psychologically accept that part of my insurance is not a revenue center. It's an expense center, or it's an opportunity cost center. So that's maybe not an explicit expense. There's other things you can do that are explicit expenses. You can buy puts on indices or individual stocks. And that's okay, especially if you have a client who co-founded a small XYZ company and he had most of his wealth, or he was an early employee of a successful company and a lot of his net worth is in one stock, you know, having some puts, say the stock trades at 40 today, maybe having a 1 year put at 30, just so that if the worst case scenario occurred, he'd have some protection. I mean, but the thing is, and I forgive me if it's almost insulting that it's so rudimentary. There's no such thing as a free lunch, and every penny we spend to mitigate volatility is a headwind to long-term return, because we either are out of the market or we're buying an insurance premium. Sometimes that's okay though. The catastrophic aspect to my family of my dying without life insurance is too much. So I willfully incur the expense. But there's such thing as buying too much insurance, such that my family's wealth has been eroded by all my defensive mechanisms. So the financial theory says when you truly have, as the gentleman mentioned earlier, the longer the time horizon you have, the less important it is for intermediate term volatility. And if we tried to make the S&P 500 a straight line, that straight line is going to be at a lower level because we would have incurred expenses to prevent it from zigging and zagging. I was joking that there are some institutional investors who are really quite smug that they lower the volatility of their portfolios when they add private real estate. So they own a building and they manage it and they lease it out, and there's no volatility. Well, of course not, because it doesn't get priced at 1 o'clock, 4 o'clock New York time. But if it did, it would show as much volatility. So it's phantom volatility mitigation. So I said, well, tell you what, buy the S&P 500, buy your favorite mutual fund, and only look at it once every 3 years, and calculate the price change once every 3 years. And you'd be amazed how little volatility there is. And that's how you get a stock portfolio look like a private real estate portfolio. You just don't price it every day.
Yeah.
So those are sort of my thoughts around that. But for me, after looking at a lot of different choices, however unsatisfying, traditional money markets do play a role if it keeps you in the game with your risk assets.
Great, thanks. So we booked Ken probably for about an hour today. I know he's been very gracious with his time. I want to give, Michelle has sent a chat. He's got a question. We got about 5, maximum 10 minutes, because I want to be cognizant of Ken's time. And then I'll ask Dave, Ralph, and we have a 646 number. I mean, I think that might be Andrea on the line as well, that if they have questions. But Michelle, go right ahead.
Thank you very much, Anthony. My question is, I would like somebody to explain to me the following. When I travel around the country, I was in New York, where I'm originally from. I live in Miami now. And I give you a few examples. I observed the destruction of the retail industry in New York, the destruction of the restaurant industry in many cities, the destruction of the commercial real estate market. My son works at BlackRock in New York City, and he has no idea when the offices are going to reopen. And it seems to me that many corporations, and I could give you tons of examples like that in large corporations, it seems to me that at some point somebody's going to say, wait a minute, why do we need all that space? Let's have much smaller spaces and have meetings once a week, whatever, with a rotation of staff. And there are many examples of different industries that are in that situation. For example, in the real estate, the landlords, I'm sure, are not collecting the rents. I see in Miami in a very Saks Fifth Avenue closed down at the Bar Harbor Mall. They were there for 40 years. The landlord is stuck. In turn, the banks are going to take the load of the mortgages that those landlords may have. And so I see a whole cascade or avalanche of situations that seems to me to be catastrophic in the future. I don't know when, and forget the presidents now. It has nothing to do with that. But at some point, the subsidies are going to stop. And what I described is going to create a huge amount of unemployment. When I was in New York, a friend of mine who was close to the city was telling me that they predict about 65% of the restaurants will never reopen. How many unemployed people is that going to be? How those people are going to eat? You know, so I'm worried that we having at the end of the story, regardless of the election, we may have a massive catastrophe. That's going to take a long time to eradicate. What do you think of that?
No, all excellent points. All excellent points, and that's why we are feeling a little squeamish about this V recovery, where vaccine is here or virus fades, and suddenly we're back to normalcy. No way. Both because of the psychological shock, as well as depleted household coffers, but also municipal coffers, budget deficits. U.S. corporations have borrowed a ton of money to try to just stockpile cash to get through. And of course, federal deficits just can't go on forever. And you have to pay the piper eventually. So I think it was it Microsoft's CEO who observed, we saw 3 years of technology evolution fast forward to 3 months. So the issues you pointed out, that countless corporations sending their employees home and the move to remote working has caused an acceleration of all kinds of digital communication, like the one we're doing right now, and cloud computing, and think of transacting, DocuSign, the basically slowly evaporation of retail branch banks, transformed into all digital. So there are so many things, and you're right. When I was tasked to do a study of hedge vehicles to own alongside equities to bring diversification, real estate, you cannot, I humbly would argue, many aspects of real estate are equally or more vulnerable to COVID-related headwinds than even equities. So I don't view them as an effective diversifier unless, believe it or not, one of the hottest real estate subgroups for the last 5 years, one of the most boring categories of real estate you could ever envision, warehouses at airports and near airports, because that's where Amazon, et cetera, stores all the stuff that when my 25-year-old, 28-year-old kid order it, it's there the next day. So it's interesting how there's some winners and losers, even in real estate. The move out of dense urban centers is enormous, and it might not just be COVID. It may be social issues. It may be, and I hate to say it, but San Francisco, we have an enormous homeless problem, in Los Angeles, and all kinds of problems related to that. And there's just the perfect storm driving people out of some very expensive real estate markets. So I think it's a point well taken. I think when we get a vaccine, when we tackle this virus, people are not going to forget how much they enjoyed a good dinner or a good time out or a good social, civic, sporting event. So I do believe when the science and the medicine get there, it'll be painful, and a lot of restaurants may change hands and be closed for 9-12 months. But I think those parts of the economy will come back. But I totally agree with you that it's very difficult to quantify how much pain there will be between now and then. And it's fair to say the government's tried to create a bridge between the pre-COVID and post-COVID world. How far the Grand Canyon is of pain, that's anybody's guess. So I generally I think what you've said makes a lot of sense. My daughter, I have 3 grown kids that work in tech, and 2 of them are told they never have to come back to the office if they don't want to. That you might have a quarterly meeting, on something like that, but a lot of the digital world that really doesn't need office buildings anymore. Finance, Wall Street, I've heard that the leaders want the leaders back. So we'll see in that regard, but that's a small microcosm of the broader economy. So I'm not sure if that was helpful in my response, but I think you made some good points.
Thank you very much. Very helpful.
Great. Thank you, Kent. I want to, Dave, I know you're on mute. I'm sure you can hear me. I know you're there. I wanted to make sure that you don't have any additional questions before I let Kent go.
I think you asked the question I had regarding,
Yeah.
after this election, usually you have an election in November, and at the end of the election, within a day or two, you know who the president is. I don't think that's going to be the case here, very possibly. I don't know that, but I think both sides are gearing up to say, oh, we don't have a clear winner. And what happens to the economy when there's no clear winner and one or both sides may go to the street with it? We've seen a lot of going to the street without the election, and with the election, I think it'll be much worse. And I think the topic was covered. That was my big question in investing today. There were a lot of interesting things about what happens with real estate. There are winners and losers in that. I think the city landlords are going to take it on the chin. So appreciate all your time, and Anthony, I appreciate you guys putting this together for us.
Absolutely. Absolutely. One more, Rohita, I believe, I just want to make sure we get all your questions. If you have any, please unmute and let us know before I let Ken go. All right. Maybe she's not there any longer. Okay. So listen, I think this was great. I mean, Kent went over a lot. I really value his time. He's an extremely knowledgeable guy. I hope we got to all the questions that you guys did, or that you had, excuse me. If you still have more, just reach out to us. We'd be happy to put another one of these together. We'd be happy to touch on the topic, and we probably will as we get closer to the election and we get a little bit more potential clarity. But in the interim, I just want to say thank you very much, Kent, for your time. I really do appreciate it. I'm so glad that everyone seems to have such positive thoughts about what's going on in the political and economic climate. But look, we're here to obviously help you guys achieve all your goals, and this is one big component of it. So our door is always open. I appreciate you guys taking the time to log on to this, to this event. If you have any, ideas and thoughts on future events, we certainly take those into suggestion. But in the interim, listen, the next 35 days, I guess, will be very interesting to see how things transpire. But rest assured, Lou and I and Kent and his team over at Franklin Templeton, we're going to be doing anything and everything we can to make sure that you guys are as minimally impacted as possible. So with that being said, I don't know if you have any final comments, Lou.
No, just maybe put it out there that at the end of the month too, we're just finalizing a date, but we're going to have an attorney on the call, and we're doing a similar Zoom meeting where we're going to talk about getting your legal documents in order. So if anybody wants to be on the call just to see what kind of documents you should have, I think that'll be very informational as well. And we'll go from there. We'll try to do one of these at least once a month if we can.
Yeah, the classic 25 documents you need before you die piece, right? Anyway, yeah, okay, great. Well, this is good. Listen, everybody, please don't keep us a secret. Obviously, Kent, we trust Kent, and they do a phenomenal job, and I hope you think very much the same of us. We'd be happy to talk about or talk to anybody that you think may need some sort of guidance in any fashion. I appreciate your time. Everyone have a great night. Stay safe, stay healthy, and look forward to talking with you guys all soon. Thank you very much.
Thank you, everybody.
Good night, everybody.
Thank you.
Bye now.